My name is Mark Lamonic. I'm the product manager for Morningstar Premium and Morningstar.com.au. And today we're going to talk about behavioral finance, which hopefully will be timely given things that are going on in the market, but we'll get to that. First, a couple housekeeping items. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. And if you're in New Zealand, you can click on the link at the bottom of the email, which will take you to your full disclosure around what we're supposed to be doing. I forgot the rest of the New Zealand one, so hopefully nobody from New Zealand reports me. Now I'm getting it. Yes. The FAP disclosure is what I'm talking about, so you can go and read that. Sorry, all over the place today. I got an email over the weekend from a webinar attendee who said I look lonely up here, so maybe that's the problem. It's a testament to how great of a cameraman Will is that my loneliness is coming through the camera. Anyway, let's get started. So we're going to talk about behavioral finance, and I do have some slides that we're going to go through, but first I want to give a little bit of background and context. And we'll talk about why I think this is important right now, but I think anyone who's attended these has realized that I at least think things are getting pretty speculative, and a lot of what drives that is things that are studied with behavioral finance. But before we can get to that, we need to talk about what came before it. So anytime you want to look at a theory, it's good to look at the theory that preceded the current theory. So we'll do that. So we're going to talk about the efficient market hypothesis. Sounds pretty exciting, right? So in the 60s, there was an economist named Eugene Fama at the University of Chicago, and he's often credited as being the father or founder of this efficient market hypothesis, but obviously there were lots of different people that contributed to it. But in 1970, he published an article in the Journal of Finance, and he talked about what he called the random walk hypothesis. So basically what that is, it's this financial theory that says that stock market prices evolve according to a random walk. So basically price changes are all random, and anything that's random, of course, can't be predicted, so that you cannot predict stock price changes. And in order to have this theory, you need to assume a couple different things. So the first thing you have to assume is that all information is instantaneously available to the entire market. So, right, everybody knows the same thing, and they know the same thing at the exact same time. The next thing that you need to assume is that all investors are rational. So they're all going to take that information that's available, because they're all getting the same information, and they're going to make a rational decision off of that information. And what comes out the end of this whole efficient market hypothesis is all security prices always reflect the intrinsic value of the security. And the reason that, of course, this is random is because the information, we can't predict the future, right? So the information we're getting about the future is almost random. It's basically random, right? Because we can't predict it. But the market will automatically adjust to whatever that information is. So if tomorrow the Federal Reserve comes out and says that they're going to raise interest rates, everyone in the market will immediately be able to figure out what that's going to do. And then they will make a rational decision in terms of their investing, and stock prices will change, but all of a sudden they'll just be worth what they should be worth given this new piece of information. And of course, all the time new pieces of information are coming out. So if you believe in this efficient market hypothesis, you believe that there's no way to beat the market because everything is random. Now, it's important to note that I don't believe in the efficient market hypothesis, and there's been a lot that has come out, and Morningstar doesn't believe in it. And there's a lot that's come out saying, demonstrating why at least many people don't think this is actually true. But one of the big things that came out was this whole theory of behavioral finance. So in the late 70s, spending a lot of time in the 60s and 70s, there was a cognitive psychologist. And famously, he said that he had only taken one course in economics over his whole life. And it's this guy by the name of Daniel Kahneman. And he introduced this new theory, and he called it prospect theory. And that was the beginning of this whole field of behavioral finance that has evolved a lot since then. And Kahneman won the Nobel Prize in 2002. And The Economist magazine named him the seventh most influential economist in the world. Which is interesting, right? Because he's not an economist. So it must make you feel bad if you're the eighth or any lower economist in the world that you got beat out by a non-economist. Yeah, just something to think about. So anyway, what is behavioral finance? So behavioral finance looks at how different factors influence the decisions that individuals make, obviously around investing. And those factors can be psychological, they can be cognitive, emotional, cultural, social factors, all these different things that influence the way that we behave. And at the end of the day, what all this stuff means is that we do not, in fact, act rationally. And this assumption that people always are going to react rationally and always do what is best for them really goes throughout economics. But Kahneman's saying none of this is actually true. So as humans, we're not acting rationally. We're influenced by all these things that we're talking about. And those are going to influence the decisions we make, and those are going to influence the decisions we make as investors. And of course, before Kahneman came out, and before this whole field of behavioral finance came out, this was known to a couple pretty important investors. And the quote that we talk about all the time by Ben Graham is, in the short run, the market's a voting machine, so voting, popularity. In the long run, it's a weighing machine. He's saying that same thing. And he died in 1976. So it's not like he was spending a lot of time reading behavioral finance work. And that quote was in a book that he published in the 40s, right? So it's certainly a notion that preceded Kahneman, but he sort of put that structure around it. And in a shareholder letter in 1986, and this is once again was before behavioral finance became popular, Warren Buffett also put it pretty well. He said, "We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." So fear and greed, this notion that fear and greed drive the market and drive the market into overreactions on both the upside and the downside, is pretty prevalent in a lot of investors' mind. And that is basically behavioral finance. So now we're going to go through a couple different topics around behavioral finance that hopefully you'll find interesting. But yeah, ask questions, please, since it makes it better for me. And as I always say, that's what we're here for. So let's talk about why this is important now. Well, I talked about how, at least I feel, and many people feel, we're in a bit of a speculative bubble now. So what is the emotion that is driving us? Well, the emotion that's driving us right now is greed. And it's this whole fear of missing out, FOMO. So I can use my little millennial acronym. That's what's driving a lot of things that are happening. So of course, when you sit there and you get all these headlines about how much Bitcoin's up, or how much a SPAC is up, or how much Afterpay is up, that can drive a lot of behavior. And you know, it's the fear that you've missed out on these gains, and that if you don't get into the market, you are going to miss out on future gains. So let's go through a couple other quotes, because quotes are fun. I like quotes, at least. Geez, what did I just print out? A lot of random notes. I'm probably printing out the same page over and over again. So I should learn how to use a printer. Geez. Okay, sorry about that. All right, so let's start going through these. So we've got this quote from Ben Graham, and this is really what's talking about behavioral finance. So you, of course, can read, but the investor's chief problem and even his worst enemy is likely to be himself. So what does that mean? It means that when these forces take over, when you are greedy and when you are fearful, for the lack of better way of describing it, you are going to make dumb decisions. And those dumb decisions are not rational if what you're trying to do is maximize your long-term wealth. They are making you feel better, and they potentially are going to make you run with the crowd for a while and feel like you don't have an opposing opinion. But they are going to, they're going to ultimately impact your long-term wealth. And a good example of this is I've talked about this a little bit with a couple of my friends. And this morning I was at the gym and I got a text message and I was like, who would be texting me 5:45 in the morning? And it was my friend James sending a screenshot of how much the US market went up overnight, because I keep saying I think the market's going to fall. And he told me it's time to lever up. So we'll see who's right. But let's go through a couple of these different biases that impact investors. And hopefully what this means is that once you are a little more aware of this, you have a little more self-awareness, then hopefully you can combat some of this stuff. So let's start with confirmation bias. So another quote from Buffett. So you, of course, can read that, but what human beings are best at is interpreting all new information so that prior conclusions remain intact. So what does that mean? It means we naturally want to be right. So what do? We go out and we search out information and data. Now I'm getting lots of text messages. Very popular. So what we're doing is we're going out and we're searching for information and data that basically proves our thesis. So what happens along the way is we become more and more convinced that our viewpoint is correct, and we don't open ourselves up to any other opinions. So what do we do with this? And by the way, this confirmation bias is getting even worse. Because of the internet and because of everything that's happened, we are now able to, and we hear about this a lot with politics, but we're now able to obviously get into a little echo chamber with like-minded people that think the same thing that we do. And I was talking to Shani this morning about a podcast episode we put out, and she was talking about this. So we can look at the engagement on our podcast, or how many people actually listen to the whole thing. We put out a podcast on buy now, pay later, and we're fairly concerned about the valuation levels and the future prospects going forward. And Shani's theory was that the reason we had less engagement on that podcast was because people disagreed with what we were saying and didn't want to hear it. So one thing I'll say is it does not matter if Shani and I or Morningstar, our analysts, are correct about these companies. If you're an investor in them, you should listen to what we have to say, because you should always go out there and seek out other opinions, because that is ultimately going to make you a stronger investor. Maybe it won't make you feel good for a little while, but yeah, exactly. It's good to go out and find other opinions. So seek out opposing opinions. Something that's pretty important. I've moved on to a new slide. Okay, so I can't print and I can't work a PowerPoint on a screen. Things are going well. Overconfidence bias. Now we've got Charlie Munger. So yeah, everyone thinks that they are better at everything, including their own knowledge, than they actually are. So you see this with driving all the time, right? So everyone thinks they're a better than average driver, which, mathematically doesn't work. So something that's important to know. So Kahneman wrote this famous book, and the book was called Thinking Fast and Slow. So he called overconfidence the most significant of the cognitive biases. And he had an interview with The Guardian, and he said this is the most significant for investors as well. And he said if he could do anything, if he could wave a magic wand and eliminate anything in the world, it would be overconfidence. Now, it's not what I would pick, but that's what he said. And yeah, he basically said this is very, very difficult to eliminate. So what do you do if you have overconfidence bias? Well, there's a lot of things to do. And of course, the whole title of his book, Thinking Fast and Slow, is one thing is to slow down your thinking and just become more aware of it and what's actually behind it, and question if you're being overly optimistic. So don't do things too quickly, mull them over. And we see this is a big problem with investing now, because it is so easy with our smartphones, before Shani took mine away from me, you can sit there and trade as much as you want, and people make these snap decisions and come to these conclusions and just act on them immediately. Well, there's no rush. So over the course of your investing lifetime, take a step back and slow down. That'll be something you'll hear a lot. And yeah, it's hard to actually do this, but try to retain a little bit of intellectual humility, and just sit there and write down, why are the reasons you could be wrong? So it's a really good exercise, and we'll talk about this again. If you have a big position in stock, if you want to buy a stock, spend some time thinking about why you're wrong. Look at all those assumptions that are going into why you should buy something. This assumes that you have assumptions and you're not just doing what your mate tells you at the barbecue, but write down all the reasons you want to do something, then write down all the reasons why maybe it's a bad idea. So that's pretty important. The other thing is, consider the consequences of being wrong. So we're seeing a lot of this now, right, where people are doing very, very risky and speculative things. They're doing that by putting, just from the investing boards that I read, a giant percentage of their portfolios into individual stocks. They're doing this by levering up. They're doing this by using options. Think through, what are the consequences if you're wrong. So what happens if you're wrong with an option? Well, you lose literally all your money. So think about what those consequences are. Everyone always tells me to think about the consequences of what I do, and I don't. But I try to do it from an investing standpoint. All right, let's move on. Action bias. Okay, this is another one. And this is one of my favorite quotes from Animal House. Everyone thinks that they have to do something. So in action bias, this happens a couple different ways. So number one, it happens when you feel like you're getting left behind. And I've seen this a lot, and you see this a lot in housing right now, right? That somebody buys a house, they post all over their social media about it, and everyone decides that they're getting left behind. And what do? They do something. So everyone always feels like they need to do something. So that is what's happening when things are going up. Your mate sitting there bragging about how much money they're making off of investing in GameStop or whatever, and you start to get this panic that you have to do something to actually keep up with this person, when of course you don't. And of course the person is most likely lying to you about the extent of what they're doing and portraying it in a different way. But action bias, people feel like they need to do something. The same thing happens when markets are going down. And every day, people are sitting there looking at their portfolios, and the portfolio values are reducing more and more, and people panic and they sell because that's doing something. And they know that if they sell the next morning or the next day when they go and look at their portfolio, it will be the same value if they sold everything. They're generally terrible decisions. So that's something to think about with action bias. One of the big things is this is sort of this evolutionary thing that we've all heard about, that we have this sort of fight or flight reflex. And the problem with an action bias is it instantaneously makes you feel better. So you'll feel better. Now, you may look back 5 years from now and look at that decision you made and realize it was terrible for your long-term finances, but it still feels like you are actually doing something. Now, how do you limit action bias? So focus on your goals. So much of the time, action bias is being driven by something external to you. So it could be your peers, it could be a market indice falling, your portfolio value falling. But once again, focus on your goals. They should be long-term goals. Doesn't matter. You can think your way through this, right? It doesn't actually matter what happens day to day in the market. It doesn't matter if the market falls, as long as you are invested appropriately for your goals. So that's why we really like focusing on our goals and using that required rate of return and changes in that required rate of return to govern actions. So we talked through this maybe last time, but that is when your portfolio is falling significantly. What should you actually be doing if you look at your goals and your required rate of return? What it's going to tell you to do, focusing on that number, is going to tell you to put more into the market. That you, in fact, when you have lower portfolio values compared to your goals, that you need to take on more risk. So if there's a huge market fall, pulling all of your money out and putting it into cash isn't a good thing to do. The same thing happens on the way up. So when markets are going up and up and up and your portfolio value is going up and up and up, putting more money into the market, taking increasingly risky bets because you're hearing about all these people making money is not what you should do. Naturally, you should be dialing back the risk. If you dial back the risk, then yeah, that's going to lower, at least temporarily, your long-term expected return, but that's fine because your portfolio value has gone up. And this is what I try to explain to my friends like James, that yeah, taking a little bit of money out of the market is the smart thing to do when they're going up because your portfolio value is still going up. But enough about James. All right, recency bias. So I'm not going to read out this whole quote because once again, I assume everyone on here can read. It's a quote, of course, by Moneyball author Michael Lewis. And you see this a lot. And the simplest way that you see this investing is when people focus on short-term returns. So we see this all the time with ETF and managed fund investors or even individual equity investors, that everyone just decides what recently happened will continue to happen into the future. And this is the whole idea of extrapolating into the future, things that happen. And extrapolating things, I guess, is great. It can lead to all these very rosy scenarios. But also, it's generally not going to work. So what do people do? They chase returns. And we have this study here at Morningstar, and it's called the Mind the Gap study. And the gap is a behavioral gap. So it's all these different things, how it influences investors. And what we found over time by looking at this, and we put it out literally every 6 months, what we found by looking at this is that the average return of an investment is better than the average return an investor gets. So that means that we are making dumb decisions, namely chasing hot investments, that is causing that gap. And the gap widens during certain periods. It widens when things are very, very volatile in the market. So what that is saying is that the stress of markets bouncing around is causing us as humans to make bad decisions. So this, in my mind, is a data point that proves that Kahneman theory, that there are outside influences, is actually true, and that we are not rational and we're not acting rationally. But yeah, recency bias. So we talked about it on the way up. Same thing on the way down, right? The markets keep falling. Everyone just decides they're going to fall forever. And that's what's going to happen. So yeah. How do you combat this? Well, a couple ways. I mean, I think it's, once again, focus on your goals and realize that that is a different way to interpret past performance, right? So that's a way to interpret looking at that required rate of return, not just looking at your portfolio value. Because the problem of just looking at your portfolio value means that every single day when you look at your portfolio, if you're looking daily, every single day, that is your new starting point, and you're going to base everything else off of that. So markets are going to fluctuate over time, which means your portfolio is going to fluctuate over time, and hopefully it will go up. But looking at your market all the time and anchoring, and we'll talk about anchoring in a second, anchoring to those certain levels can be really dangerous as an investor. All right. Let's keep going through these. We've got a couple questions, so keep the questions coming. All right. Information bias. Okay, so I really like this quote from Buffett. Because it reinforces a couple things that, I believe and we believe at Morningstar, is that only buy something you'd be perfectly happy to hold for 10 years. So what does that mean? It means focus on the long term. Don't focus on all these little price fluctuations. And there's a couple things that happen with this. So we are bombarded by information every day. We're bombarded by, of course, things coming over the internet. We are bombarded by share price movements or movements of any sort of investment you make. Mostly that is useless information to you. I know you're going to think, of course it's useful because it means how much my portfolio is worth. But the day-to-day fluctuations are useless. It's useless information. So the idea that Buffett is talking about here is to tune all of this out and focus on the long term. And he's basically saying that if the market shut down, that primary source of validation that people are getting, market prices that you get, every minute they're updating over the course of a trading day, that is all besides the point. What you should be concerned about is how a company does in the long term. And for the most part, you're not getting much real information about how a company is doing. You're, of course, going to get their earnings reports. All of those, of course, are looking in the past, not the future. But it is just basically getting rid of all of this noise. So, as somebody who runs a website that we do like people to come to, maybe this is bad advice, but how do you actually combat this? Stop looking at the market. That's a simple way to do it. Come up with set periods where you will go and look at your portfolio and look at your market and look at the market, and that can be the way that you sort of remove some of this information bias and the influences it would have with you. And I assume that she's on here, but yeah, I tell my mother this all the time, that, she would look at the market every day and then send me a message about it. And I said, just stop looking, stop logging into your account. And that's not so I can siphon money off of her. Siphon money off of her. That is because all that does is all it does is induce bad behavior. So pick times that you'll look at the market. So whether that's monthly, whether it's a quarterly review that you do, and keep all of those reviews focused on your goals, and smart things to do like rebalancing and things like that. But looking every day can be a problem. Now, I will say that a lot of investors are more like hobbyists, and I put myself in the same category. I was looking at the market before I went on here. So I know that this is hard to do, but at least if you understand this information bias, then hopefully you can realize that 99.9% of the information you're going to get is completely useless and can't help you make any sort of better investing decision. But still, visit morningstar.com.au daily. You can read the articles and ignore the other stuff. All right, so let's look at anchoring bias. Now we've got a quote from Kahneman, which is nice. So anchoring bias is an interesting one. So people tend to anchor onto either experiences they've had in their life, certain data points, and they rely too heavy basically on a past reference or a piece of information when making a decision. And we see this all the time. I've got I'll talk about my own biases. We see this all the time when, and the classic thing you get to hear is when parents tell their children that the way to success is doing X, Y, or Z, when that was the way that they were successful in a very different world and a very different environment. And you see this stuff around property all the time now, which I always think is insane, that the only way to build wealth apparently is to buy property. Well, people weren't buying property when it cost nothing and before you had 30 years of interest rates going down. So that's an example of advice that probably made a lot of sense at a certain time and maybe doesn't make as much sense now. Now, I'm not saying anything about property. I don't want to get inundated and have people with pitchforks show up here to go after me. But what I am saying is that you need to judge the property market by what it's doing now, not what happened in 1980 when you bought your house at a 17.5% mortgage and it cost $5,000. That is not how we should judge what's going to happen going forward, right? So I think the past, and as somebody who was a history major in uni, I'm very into the past. I think the past can offer clues, but to just blindly assume that the exact same things are going to happen in your children's lifetime as your lifetime, and they should just do whatever you did, is not a great advice to give, in my opinion. This, of course, is why I don't have children, so nobody has to listen to my advice. And of course, nobody's relying on me, which is good. All right, so how do people anchor? And I have a good embarrassing story about myself with anchoring bias, which I told before. So how you also anchor in investing, you anchor on a price. And this can do a lot of really bad things. At the end of the day, it doesn't matter what you paid for an investment. It matters what the prospects are of that investment going forward. But people anchor on prices. So they will anchor on potentially their cost basis for an investment. And they'll say things like, you know what, I can't sell until it gets back up to my cost basis, well, of course you can. Now, I'm not saying that you should overtrade, but that past price is kind of irrelevant. People anchor to portfolio values. So they will sit there, and especially when they cross a threshold, whatever that threshold may be, if it's $10,000 or $100,000 or whatever that threshold is, people cross that threshold. They've just decided that that is how much their portfolio is, even if it goes down a lot. Now, nobody ever anchors the other way. Nobody ever sits there and says, geez, remember when my portfolio was $100,000 and now it's $200,000? This is really good. Nope, they've all decided they have $200,000 now. So people anchor to certain levels. Now, I did this, which was exciting. During the fall last year, right around this time, a couple of weeks ago, I wanted to buy MasterCard. So MasterCard I thought was a great business, right? You know, the whole payments thing, no more cash, all this stuff. And as somebody who clipped a little bit of a ticket on most payments, I thought MasterCard is a great company to own. I still think it's a great company to own. And for some reason, in my head, I decided I was going to buy it when it got under $200. Now, it kept falling and falling and falling, and I just kept this stupid number in my head. And I would sit there in the morning and I'd watch the US markets, and I think it closed at 201 one day. And I think it got pretty close to 200. And I just didn't buy it because it didn't go below 200. Well, now it's 363. I never bought it. So I potentially lost an opportunity to buy a great company because I was anchoring on a silly, meaningless number. So that's an example of anchoring bias. So how do you actually combat this? How do you combat this? Well, once again, realize that these numbers that we are focusing on do not actually matter, and focus on your original thesis for buying the stock. Focus on valuation, of course, with a margin of safety, but realize in the long term, these tiny little differences in value really don't mean anything. Oh, here it is. Look, I put in a slide to illustrate my embarrassment. Okay, so here's what MasterCard, now this is old. So it's gone up to $363, right? Which is above its high. So here's what it did. It had this tremendous fall last year. And it got down here, which is right around where it was like closed at 201 one day. And this is where I did not buy it. And if this chart extended past July, it would be way up above here. So it's up above this top line again. So another dumb decision on my part, but one of many. So, all right. Oh. So let's get to some questions. There aren't many questions, so this might be another quick one, which Will be happy about. All right, so what do we have? Lisa of Alpaca fame, of course, says, is it sometimes best to do nothing? It is almost always best to do nothing. So that's another way that you can look at all of these decisions. Don't do anything. I think I used this before, but what's that movie? Forgetting Sarah Marshall, where he's learning to surf and he's laying on the board, and Kunu, who's Paul Rudd. Thank you, Laura. Paul Rudd sitting there teaching him to surf, and he's popping up too quickly all the time, and he just sits there and says, under the influence of a lot of weed, keeps sitting there and telling him to do less, to the point where he's just laying on the board and he doesn't get up. And he goes, well, you got to do something. So that's investing, right? Like, investing isn't supposed to actually be interesting. Investing is supposed to be focused on the long term. You should be doing less. So it's good advice by Lisa. Almost all the time, it's best to do nothing. And if you put your decisions within that framework, it's a really good thing to do. All right, so we've got a comment from Wayne. Isn't setting a buy price based on your own valuation anchoring? Kind of, but let me show you something. We're going to go to the website. So valuation is an interesting one. So valuation is, I got to share this. I am very inept today. I'm very inept every day, but it's really showing. Sometimes I can fake it better. All right, so let's look at InvoCare. It's a stock that I own, so I like looking at it. Now, yes, anchoring to a fair value, as we say, $15.30. That is the fair value that Angus, our analyst and new father, has rated InvoCare at, or has said that it's worth. $15.30. So yes, looking at that number, number one, the problem with these fair value calculations by anybody is that they're imprecise and they're based on the future. And that is the whole reason we invest with a margin of safety. And that margin of safety is what protects us from the imprecision in calculating how much we think something is worth. And also, of course, the fact that the future is unknowable and a lot of different things are going to happen. So that is why we shouldn't be focusing right at that valuation level. We just need to build in this adequate margin of safety. So in InvoCare's case, we rate it as a 4-star stock because it's currently trading at $11.36. And that margin of safety is what we should focus on, realizing that if it's 25% below or 30% below or 24% below, it shouldn't really matter. Now, once again, it's easier said than done because as I use for my own example. So that's, I guess that would be my answer to your question, Wayne, that yeah, focusing on the precision of a fair value, would be anchoring, but realizing that we want to buy something with what we think is an appropriate valuation and realizing we need a margin of safety hopefully allows us not to anchor on a certain number. And look, InvoCare is up 4 cents today. So I can probably quit my job. So maybe this will be my last webinar ever, which you're all thinking, what a blessing. Will's definitely thinking that. Will made up this trip to Queensland so he wouldn't have to do one of these webinars later in April. So let's see. If there are any other questions, please send them through. Or we might just end this thing early. Oh, Wayne said thanks. You're welcome. That's very nice. All right, so we've got a question. We've got a question from Michael. And so what Michael is looking at is, or what he's asking about the Dow Transportation Index. So he says, some say the Dow Transport Index is a front runner of the market direction. Does this still hold true? Okay, so a lot of people say a lot of different things about what are early or lagging indicators in terms of types of companies. So what is the Dow Transportation Index? It is just looking at, it's just an index made up of companies that quote unquote are in transport. So think railroads and airlines, and a lot of the shippers are in there. So like FedEx and UPS and things like that. So those all fall, trucking companies, things like that. They all fall within that transportation index. And what the assumption is that during different parts of the market cycle, different types of companies will do well. So a lot of the assumptions around some of this transportation index is that when the economy is starting to heat up and kick off, what's kind of the first things that benefit? So those are cyclical companies at the end of the day, versus companies that are not cyclical, which are things like toothpaste and food and things that you have to do all the time. So yeah, Michael, it's tough to say. That's certainly something that people have always looked at, that, you know, as you see improvements in, if we want to take FedEx or UPS, that, yeah, people are shipping more goods and they're now buying more stuff on the internet, more stuff's getting transported on railroads. That is an indication that the economy is doing very well. So yeah, logically it holds true. That's of course assuming that investors that are looking at these things realize what's actually happening with these companies. But yeah, that could hold true. Just be careful of some of these things that become rules, because then people just act on them without any of the underlying things happening. So if we're just looking at stock prices, maybe people are bidding those up in anticipation of it happening. Because remember, we're always back testing stuff. That's how we come up with these rules. But yeah, I mean, it certainly makes logical sense. All right, our favorite attendee, the anonymous attendee. The MasterCard chart. Regarding the MasterCard chart, why wasn't it up to date with market price? Wasn't it months behind? That is true. I will get an up-to-date chart, which I'll show you right now. The reason that happened is because I am inept with PowerPoint and I sent myself the wrong presentation. It's one that I gave a while ago. But through the power of the internet, we are going to get an updated chart. So, hold on one second. The internet may be powerful, but it's sometimes slow. All right, so let me share this again. All right, here is a new chart. So this once again shows the follies of my actions. So here we go. So this once again, down here, so picture me sitting in my living room watching some stupid television show when this happened. Oh no, that's the wrong time period. I don't remember where we are. Anyway, must have been 300 I was anchoring to, not 200. Or where are we? Oh no, here we are. Okay, here's 200. We found it. All right, somewhere around here. At the end of March, I was sitting in my living room thinking, wow, I can't wait till this thing goes down a little bit more. And then, of course, I didn't do it, and now it's up to $363. So this is a 3-year chart, because I think if I go back to 1 year, I'll just miss this. So it was right before there. But yeah, that's me making mistakes. Maybe if I would have gotten that one right, then I could quit my job. And I don't know what I'd do, but something. All right. I do have a lot of questions. You want to come on and answer some? Because then people would make comments about me being lonely. Okay, so we've got a question from Jeremy. So he says on Morningstar, can we see the detail behind fair value calculation, growth rate, assumption, discount rate, etc.? The reason I ask is your fair value in InvoCare is out by about $5 on mine. I'm interested to know if yours is up by 5 or below ours by 5. So the detail is within the analyst model, so we don't share all of that detail, but they will share those. They will share those drivers. We'll use MasterCard as an example. They will share those drivers. I, of course, have to share the screen in order for you to see this. They will share the drivers in their research reports. Now, it's probably not, if you're building your own model, Jeremy, it's probably not all the detail you are looking for. But right here, this fair value and profit drivers, that's really where they will share some of this. But you're right, you don't get all of the detail that goes into each one of their models. All right, so anonymous attendee has a comment. Can doing nothing be as bad as having an action bias? Yeah, in a way. So, okay, so doing nothing, once again, you got to do something. Doing nothing, I guess I'm referring to not, you need to be doing a couple things. You need to figure out what your goals are, why you're investing. You always hear people saying that they automate this stuff. You need, as in they're putting money in every month automatically, they're not touching it. You need to do something. This is not a call to sit in on your parents' couch and wake up when you're 50 and think, I should get a job. You need to do something. The point is that people overtrade, and overtrading is a huge problem for investors. Huge problem for people in general is that they don't invest. So if you're someone who doesn't invest, then figure out an investment plan and figure out a way that you can plan, save, and prepare for your future. But if you're an investor, one of the biggest problems is overtrading. So that's why I said do nothing. But that's a good call out. I got too caught up in my story about the movie, forgetting Sarah Marshall, and everything else. Okay, somebody complimented me. That's nice. So Jeremy's fair value for InvoCare is $10. Okay. So that is different from ours. You're right. So ours is $5 before that. So you actually think it's overvalued. Well, I hope we're right, and you're not right, Jeremy, just because I own it. But yeah, I mean, I think send me an email, and I can probably get some more of the assumptions for you that go in there. Anonymous attendee says, yep, you really missed out there. Assume talking about my MasterCard screw up. So someone says, why would you call it your folly? Also, the anonymous 10B, you could have known that it wouldn't go below 200, right? Well, yeah, I mean, I didn't know, but I think the whole point of it is that I was anchoring, it was $2 away, and I was anchoring on this made-up number. There's nothing about 200 other than it's like a milestone number. And the only milestone numbers that are important are milestones we have for Investing Compass, our podcast with downloads, because then we go out and celebrate. So we need 19,000 more downloads for the next celebration. So if everyone could listen, that would be great. We got another comment from Randall saying, is doing nothing a default position? Yeah, once again, I probably oversold that. All I'm saying is that you should think about that anytime you do something, there is at least a strong possibility that it's bad. So that's the whole point about writing stuff down, having a plan, challenging yourself. Is this something I need to do? Putting a speed bump into your decision-making process, or not your decision process to actually do something. So everyone talks about how great ETFs are. This is a little bit of this is for you, Shani, since you love funds so much. Everyone talks about how great ETFs are. But one of the problems, and one of the reasons I talk about how great they are, is because you can trade them all day. Well, that's a bad thing. So it's not a great thing as an investor that you can just trade things all day. The good thing about funds is that they have a natural speed bump in there. And that speed bump being that, yeah, you can't trade them all day. And that you know that as an investor, that you're not going to sit there and make an ETF trade or a fund trade when you're out to lunch, that it takes a little bit of time. Certainly there's time to fill out paperwork, but you're not going to actually get a price or anything until the end of the day once a NAV is struck. So that speed bump, and any speed bumps you put in there before your actions will stop you from doing things that potentially can harm you long term. Doesn't mean you're not going to do something. It just means spend a couple days thinking about it, challenge yourself, come up with that list of all the reasons why you could be wrong, and at least putting that natural speed bump in there will prevent you from potentially doing something bad. Okay, so good question from Jeremy. You're probably not going to like my answer, but good question. So Jeremy's saying with MasterCard, would having had access to trend price charts a day or week before have helped you? What are your thoughts about bar and candlestick charts to make this sort of call? Okay, so what Jeremy is talking about is technical analysis. Now, technical analysis is what it basically means is that people are reading charts to try to figure out if they can have short-term predictions about how stocks are going to bounce around. Now, I'll start by saying something good about technical analysis, and then I'll talk about something else. So technical analysis, it is important to realize that because there are a lot of traders in the market, and there are a lot of people, and we don't believe in this at Morningstar, but there are a lot of people looking very, very short term, that you do get certain things like resistance levels in stocks on both the up and downside, and these things are real things. That being said, I think really the point with MasterCard that I was trying to make is that as a long-term investor who hopefully would own this forever, or for at least a very, very long time, I made a mistake because knowing I had that really long time horizon meant that $1 or $2 in price did not matter, especially on a $200 stock, right? So $1 and $2 matters if the stock's $5, but because this is 0.5%, who cares? And if I look back and look at some of the best investments I've made that I've owned for a very long time, none of this stuff matters. Just because hopefully over the long term, that would just get swamped on the upside. So yeah, we don't really believe in technical analysis at Morningstar. But yeah, maybe if I was just trying to look very short term, that's something I could have done, but I don't really know how to do it. So that's a problem. So Michael says everyone makes mistakes sometimes in investing, and it's good as long as you learn from it. So thank you. That's encouraging. I hopefully learned from that. At least I talk about it a lot. All right, so the anonymous attendee, could be another one, could be the same person. Do you think the ASX share market game is worth playing, increasing one's skills, etc.? Appears the winner's trading a lot, contrary to what you were saying. Okay, so what is the ASX share market game? So it's something that the ASX puts out. And so I think it's every 6 months, they come out with this share market game. And basically what that allows you to do is it allows you to set up a dummy portfolio. So you can make whatever trades you want. You can make any sort of investments you want. And then a winner will be declared after a set amount of time. And I don't remember what that amount of time is, but it's pretty short term. So what I would say is if the ASX share market game encourages you to learn more about the market, then yes, absolutely do it. It's a good way to learn without actually losing real money. And one of the things we always hear when new investors come into the market, and they always come in during times of a lot of speculation, like now, like 2000, what we always hear is at least people will learn from the mistakes they made. And that's true, but a lot of people just won't come back once they've lost real money. So there's two sides to that. So I would just take the ASX share market game for what it is. I would invest short term with real money. I'd be focused on long-term goals. But yeah, if that's going to teach you a little bit about the market, that's important. What it should teach you, hopefully, is that there's a lot of volatility in the market, and that volatility probably doesn't matter in the long run. One of our analysts here, one of our manager research analysts, won it, I think, a couple years ago. This guy by the name of Tim Murphy, which we all gave him a lot of crap for. But because he's Tim Murphy, he did not care. But yeah, I think he actually won it a couple of years ago, or at least did very well, top 5 or something. All right, so we've got a question from Kim. Will, you'll like this one. Plus, you might have to answer this one. Kim is asking, are you aware of any funds investing in blockchain, technology, or cryptocurrency, please? Did you put in the blockchain link to the webinar, Will? Is that what you put below that in the comments section?
No, but the podcast.
Oh, the podcast. Yeah, the blockchain one.
No,
just in general.
Yeah, the whole podcast.
Okay, settle down. Stop yelling at me, everyone. All right, so so we do have a blockchain. We do have a blockchain webinar. So blockchain or cryptocurrency. So a couple things just happened. Canada, as an American, our friends to the north, I have a lot of Canadian jokes. Canada just approved an ETF for cryptocurrency. US regulators have not done that. The SEC has repeatedly turned those down, saying it's speculative, saying people shouldn't be investing in it. Some people do think now that Canada's done it, and as an American, this would be embarrassing that we would actually follow them in anything or do anything because the Canadians did anything, that this will be approved in the US. So right now, I don't think there are funds or ETFs, except for this Canadian one where you can directly do it. You can, of course, go in and buy the currencies directly. The other thing is Raise. So if anyone's heard of Raise, so Raise is one of those micro-investing sites and that you can access here in Australia. So they have these things called custom portfolios now, where instead of taking one of their predefined portfolios, you can go in and put whatever percentage you want into the different ETFs that they have. They actually have the capability of investing in crypto. I think they cap it at 5% of your portfolio or maybe 10% of your portfolio. It's a pretty small number, of course, because they're worried, I think, that it could be pretty speculative right now. So that's an opportunity to go in there and look at crypto. Okay, so this ARK Innovation Fund, apparently also, I'm getting these notes, invests in blockchain tech as one of its pillars. So this is a fund that you can hear about in our latest edition of Investing Compass, where we look at star investment managers and what they're doing. And ARK has a fund manager, I think she runs the whole company, named Kathy Wood, and she is a big investor in blockchain. And what she's basically, this Future Opportunities Fund, the reason it's so famous is I think it returned 150% last year, which will make you pretty famous. And they, interestingly enough, had complete transparency to every trade that they do. So literally, as they make a trade in their fund, they will publish that trade for everyone to see. And yeah, that's an opportunity apparently. So thank you for sending that to me, Shawnee. So it looked like I knew what I was talking about. All right. If there's no more questions, I think we will end that. So on Thursday, what are we talking about on Thursday? I knew this morning. Sorry? Kill some time while you look this up. We've got another one of these things coming up Thursday. I literally wrote this out in an email this morning. SPACs. Speaking of speculation, we're going to talk about SPACs. So we'll talk about the Shaq SPAC. We'll talk about the octopus. We will talk about all the ways that you can lose money with SPACs. And we can talk about why there have been over 400 IPOs in the US this year alone in 3 months, where the previous record was, I think, 486 for a year. And it's up 941% since Q1 last year. And all the reasons why that's a problem. And people that invest in SPACs are going to lose money. So we'll talk about that on Thursday. So thank you guys for joining. And if you have any questions, please send them through to mark.lamonica1@morningstar.com. Also, any emails talking about how lonely I am would be appreciated as well. I feel less lonely with the emails, but thank you guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.